First, I will explain three key terms related to fraudulent financial reporting. First, earning management is when management use accounting judgment and estimates within accounting standard to influence reported earnings. Is it usually done to smooth income or meet profit targets? While generally legal, it can sometimes mislead user of financial statement. Earning manipulation is more serious. It involves deliberate falsification or misstatement of financial information, such as recording fictitious revenue or hiding expenses. This practice violates accounting rules. It's considered fraud and can result in legal penalties. Finally, creative accountings refer to use flexibility of loopholes in accounting standard to make financial results appear more favorable. Some practice may comply with the rules, but they can distort the true financial position and mislead investor. Creative accounting sits between earning management and earning manipulation in terms of legality and ethical risk.
There are three techniques used by companies to get involved in creative accounting and earnings management. First, companies may engage in creative accounting through revenue recognition timing. Management may recognize revenue earlier or delay it to another period in order to increase or smooth reported profits. This helps the company meet profit targets and present better financial performance, even though the actual business activity may not have changed. Second, companies may use expense capitalization as a technique for earning management. Instead of recording certain costs as expenses immediately, these costs are treated as assets and spread over several years. As a result, current year expenses are lower and profits appear higher, making the company look more financially stable. Lastly, companies may manipulate provisions and accounting estimates, such as bad debt or warranty provisions. Management may create higher provisions during good years and reverse them during poor years to smooth earnings over time. Although some estimation is allowed under accounting standards, excessive manipulation can mislead users of financial statements.
The first key incentive is performance-based compensation. Financial managers and accountants are often evaluated based on financial performance measures such as profits, earnings, targets, and KPIs. This creates motivation to manage earnings in order to secure bonuses, career advancement, or job stability. The second incentive is pressure to meet market and stakeholder expectations. Investors, shareholders, and lenders expect companies to demonstrate consistent and positive performance. When actual results fall short, management may use earnings management techniques to smooth income and present a more stable financial position. The third incentive is the avoidance of financial distress and regulatory consequences. Companies facing financial difficulties may engage in creative accounting to avoid reporting losses, breaching loan agreements, or attracting regulatory scrutiny. This allows firms to protect their reputation and maintain access to external financing. In conclusion, these incentives shows that creative accounting and earnings management are often driven by economic pressure and performance expectations, which can ultimately lead to misleading financial reporting.
I will explain how organizations and regulators can reduce the negative effect of creative accounting. First, strong corporate governance is important. Independent board members and audit committees can monitor management and prevent manipulation of financial information. Second, strong regulation and enforcement are needed. Clear accounting standards and strict penalties for misreporting can reduce unethical accounting practices. Third, audit quality and independence must be maintained. Independent external auditors and auditor rotation help ensure financial statements are fair and reliable. Finally, transparency and ethical culture should be promoted. Clear financial disclosure, ethic training, and whistleblowing system encourage honesty and accountability. In conclusion, these measures help protect stakeholders and improve the credibility of financial reporting.
My name is AQILAH and I will briefly discuss major real-world cases of fraudulent financial reporting, both in Malaysia and internationally. First, in Malaysia, a well-known case is 1MDB scandal, involving large-scale financial misreporting and misappropriation of funds, with about 4.5 billion US dollar involved. Another case is Cyber-Dynamic Holdings Berhad, where auditors raised concern over unverifiable contract and revenues, which reported figures that were allegedly misleading. Next is case outside Malaysia. We have WorldCom in the United States, where operating expenses were wrongly recorded as assets to inflate profits, overstating earnings by about 11 billion US dollars. The next case is Toshiba Corporation in Japan, which manipulated earnings through premature revenue recognition and delayed loss reporting, overstating profits by around 1.2 billion US dollars. Another major case is Wirecard AG in Germany, where fake cash balances and fictitious transactions were recorded, leading to 1.9 billion euros in missing cash. In conclusion, this case shows how fraudulent financial reporting can seriously mislead investors and damage trust in financial markets.